This interview is sponsored by Grantstone Shoes. Grantstone Shoes is a third-generation family of shoemakers that uses high-quality leather to make very high-quality men's dress shoes and boots at affordable prices. Mo and I each have a pair of these shoes. We think they're good. We've been wearing them for over a month now, trying them out. If you don't believe us, go check out the customer reviews for Grantstone Shoes. They have a lot of 5-star customer reviews. They also have excellent reviews from independent fashion bloggers. And if you like the shoes, enter promo code GOLD, that's GOLD, on the grantstoneshoes.com website for 10% off your order. That's grantstoneshoes.com, enter promo code GOLD for a 10% off discount. Hi everyone, it's Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is head of research at Gold Money, and he has over 20 years of experience working in the financial industry. Alasdair Macleod, thank you for joining me again.
That's my pleasure, Jason.
Now, Alasdair, there's been a lot going on over in Europe. So we have the Brexit, which occurred around the end of June, the Brexit vote. Do you think any major strides have been made to separate the England from the European Union and get the bureaucrats in Brussels away from your country and your economy?
Well, officially they can't do anything until they serve notice under Article 50, which will be done in March next year. But behind the scenes, I have no doubt at all that two things are happening. Firstly, the cabinet are trying to get their heads straight as to what the correct approach is. And secondly, I think that there are various countries talking to the UK about free trade agreements. So those two things, I think, are running along, even though officially nothing is meant to happen until March next year. Once Article 50 is triggered, we then have 2 years effectively to renegotiate the trade situation with the European Union, amongst other things, because obviously we've also got to look at immigration and all those aspects as well. So the real sort of visible fun and games will probably start next year. But having said that, I think that there are enough indications on the free trade side to give the government confidence that they can actually come up with a better deal than the one we have at the moment. Not necessarily with the European Union, but certainly with the rest of the world and the European Union, if you like. And interestingly, today, one of the car manufacturers, Nissan, after saying, well, Brexit's terrible and all the rest of it, and we'll have to rethink our investment decisions and all the rest of it, they have now actually agreed that they are going to build their new Qashqai 4x4 in this country, and they will make the investment for it. And I think that's probably another 2,000 jobs or something. So you can see from that, if that is an indication of the thinking of big business has been trying to stop Brexit because it likes to lobby to give itself a position of power. It has failed to do that. It is now facing reality, and it now has to get on with its plans. And the fact of the matter is that out of all Europe, with the possible exception of the Czech Republic and Germany, Britain is the best place for manufacturing. Our workforce is highly skilled, highly trained, and the government here is far more in tune with free markets than any government in Europe. So there are actually some pretty strong benefits to anyone investing in industrial production in this country in spite of Brexit.
Donald Trump has brought this up about the United States, and I'm sure it's very similar in England, but a lot of these free trade deals, and I'm using air quotes right now, are free trade in name only. There's an enormous amount of cronyism in there and lobbying and deals and bribes to politicians. And I was listening to a speech from Lew Rockwell talk about how he went over to the printing office in Congress in Washington, D.C. when NAFTA came out, and it was thousands and thousands of pages, and it didn't talk about anything about free trade. It was called the North American Free Trade Agreement, but it just had, entire paragraphs for individual corporations listing all their, individual deals that they were getting, all their corrupt crony deals. So I think, I'm in favor of free trade, but a lot of these deals that get passed are not in free trade. So the corporations, I'd like to see them compete And when we have these guys talking about anti-Brexit, I mean, these corporations have plenty of resources. They could easily adapt to whichever way. So it just is frustrating for me, for someone that wants free markets, when we have these corporations saying they're against all these things when they could easily adapt.
Yes, I quite agree with you, Jason. And I mean, the fact of the matter is, the reason that big companies do this is they like to have an edge on smaller competition. The whole of Brussels is all about lobbying. If you were, I don't know whether I should say lucky enough or unfortunate enough to be elected as an MEP, you will find that suddenly there are a whole load of invitations on your desk to attend this cocktail party, that lunch, etc., etc. And it's just pure lobby briefing. And that's what the companies do. And the big companies set the rules. I mean, when you get something like changes in safety regulations for motor cars. Do you think that the bureaucrats sit in Brussels and actually think these things up themselves? No. It's Mercedes and it's Volkswagen and it's all the big businesses. So they know 2 years ahead of these things actually sort of hitting the street. They know what the regulations are going to be because they wrote them. And that means that they can plan forward into their production, and that way they will always have the jump on a smaller competitor. That's what it's all about.
Yeah, I completely agree. Now, I want to ask you about the British pound. In the last couple of weeks, there was a flash crash with the British pound. I think it dropped 6% in only 2 minutes, which, in the past with the currency markets, a 1 or 2% move over a year or two was a big deal. Now we're having these enormous moves in the currency markets, enormous volatility in a matter of minutes or a matter of weeks. Do you think this may have been some type of retaliation by someone like George Soros for the Brexit vote, or do you think this was just a malfunction then of these high-frequency trading computer algorithms?
I don't think it was someone like George Soros. Let me get that one clear. What was actually behind it, I don't know. High-frequency trading is quite likely, algorithms gone mad, whatever. You could also argue that there's quite a lot of fear with people who got themselves blindsided on the wrong side of sterling after Brexit. And when you get a sort of thin market at whatever time it was something like 11 o'clock at night, our time, which was, well after your market shut there, you find in thin markets, it doesn't take very much panic for suddenly everybody who's got a position to see their stops triggered and think, oh my goodness me, this is terrible. Have you heard the news? What is the news? I don't know. What is the news? Finally, there is no news. The thing recovers, and it probably recovers with a little bit of help from the central bank dealers.
Yeah, it reminds me similar of how, the gold and silver market is manipulated in illiquid trading hours, how things are moved one way or another at inopportune times when most traders aren't even trading. Precisely. You've written articles in the past on Gold Money about the euro collapsing. Do you think after Brexit, do you still see that happening in the near future with other countries in the European Union?
Yes, I do. And interestingly, if you look at the chart of the euro against the dollar, you can see that it's completed a continuation head and shoulders with the neckline finally being broken at around about 109.50, something like that. And there's a little bit of sort of rallying, backing and filling. But basically, now that that has happened, I think the next support level is around about 106 to the dollar. And if that fails, which I guess it will, because we've got a few things coming up which might ensure it will, then on that basis, you're suddenly looking at part of the dollar. And that has great implications, obviously, for the interest rate setters in America, because they've already seen the dollar be very strong. It's been consolidating more or less for the last 8 or 9 months. But if DXY, which is the traded dollar index, breaks out above 100, I think that would create a certain amount of panic in the Fed when it comes to interest rates. Not so much because they're worried about European companies exporting into America, though they are. I mean, you look at the motor manufacturers in particular, BMW, Volkswagen and Mercedes. I mean, they do incredibly well. I think they're more worried about China because the trade with China, I think I'm right in saying the last month's reported trade was something well over $400 billion worth of imports from China. That was sort of balanced by some exports, but only about 100 billion. So the net imports from China are very substantial and at record levels. And I think the Fed is very, very conscious of the fact that if you drive up the dollar, then it's going to just squeeze domestic business, and it's going to bring deflationary pressures to bear on the U.S. economy. So with the euro breaking down and looking like it's going to go quite a bit easier against the dollar, I think the ramifications for interest rate policy in the United States should be watched very, very carefully.
Yeah, I agree. I think the Federal Reserve has been watching the dollar index very carefully. So when the dollar gets weak against the euro and the Japanese yen, then the Federal Reserve starts talking about raising interest rates. And then when the dollar gets too strong, they start talking about, oh, we're going to do more, quantitative easing, or we're going to start buying up these assets or that, or we're not going to raise any interest rates. So they're trying to keep the dollar index in a range. It's like Goldilocks, I guess, with the three bears. They don't want the dollar too strong or too weak. They're trying to, I guess, manage its gradual decline. But we all know how things work with these central bankers, that, things don't go as planned when these central bankers have a plan.
Well, I think you're right on that. And actually, don't think they've got very much control over it. I think the central bank with the control over it, and this is an article I've literally just released this evening, is the People's Bank of China, because they have been selling U.S. treasuries and dollars into the market and investing the proceeds mostly into commodities. They've also, incidentally, been buying some Japanese government bonds. But it's quite clear that with China selling treasuries and dollars into the market, the demand for dollars is so great that has been more than absorbed. So all China needs to do, basically, is to slow down the pace at which it lets treasuries and dollars into the market, and hey presto, the dollar rises against the Chinese yuan. And I think, this has happened twice in the past, ahead of promised interest rate rises in America, and as a result of what the American press see as a devaluation of the yuan, which actually it isn't. It's a revaluation of the dollar, really under the control of the People's Bank of China. That has actually deferred and put off rises in interest rates. So I would say that monetary policy is actually being dictated by the Chinese.
That's very interesting. And I know the Fed has been talking about an interest rate increase. Actually, 4 interest rate increases were promised in 2016. They haven't really done one. They did one in December of 2015, and that almost, caused a market crash. It caused gold to go higher. We have negative interest rates on government debt, over $12 trillion of negative interest rates, and on corporate bonds in some countries. Do you think then that anyone can actually raise interest rates at this point, or people? I really don't. I see a math problem with raising interest rates. I just don't see it in a meaningful way. I see, maybe a quarter point, and then the Federal Reserve will watch what happens, and then market asset prices will start to have a correction, and then the Federal Reserve will back off again. Do you see the same thing, or do you see things differently?
Well, broadly, yes. I think they can raise interest rates. Don't get me wrong, but I don't think that it's in the central banker's DNA to do so. And the reason that they've got other problems with this is that they've got an eye, as you rightly point out, on the valuations in bond market. And this is important because bank balance sheets, particularly in Europe, are very, very long of sovereign debt. And they're long of sovereign debt basically for regulatory purposes. If you look at the Basel II and now Basel III coming in, if you want zero risk weighting, then basically you hold sovereign debt. And it doesn't matter whether it's Greece, Italy, or Spain. It really doesn't matter at all. It's zero. It's zero weighted for risk. So they've all got this stuff on their balance sheets. And if you get a bear market in bonds, it's not going to take very much of a bear market in bonds to destabilize the Eurozone banking system. They've got other problems as well. I won't go into that as in an answer to this question. But I think as far as America is concerned, the level of debt in both government and private sector is now so high that it would only take a rise of interest rates in the order of about 2 to 2.5% to destabilize the whole financial system. Now, that is very, very different from when we had the Lehman crisis. It took a rise up to about 5.5%, 6% at that time. The time before that, which is the time of the dot-com bubble, you were looking at a rate of around about 7% from memory. And so you've got this sort of declining peaks over time, which, because of the increase in outstanding debt, those peaks are declining and declining and declining. And they've declined from the high back in 1981 when Volcker raised interest rates in the United States up to 20 to 21%. So you can see that now that with all this debt overhanging the market, it's going to take a very small rise to destabilize the whole financial system. And I think in the background, certainly various members of the Fed must be aware of this, and I think it quietly terrifies them. What they want, I think, is to see the sort of economic growth so that you have got the earnings coming through to pay for the debt, try and keep interest rates as low as possible within that context, and just hope you don't get bitten in the backside by inflation.
Yeah, but I think the stagflation we have now is only going to get worse. You and me have discussed this in the past. We see a lot of stagflation coming. Even Alan Greenspan now that he's left the Federal Reserve, has said there's stagflation now. I'm sure he got a phone call from President Obama and maybe Janet Yellen and others telling him not to talk about that. So do you think then if there is a correction in asset prices rather than raising interest rates, do you think the Federal Reserve will lobby then to start buying individual stocks and corporate bonds like other central banks are already doing?
It wouldn't surprise me at all. When you've got a system which has failed and is in panic, then anything which it thinks might work, they'll try and do it. I think it's as simple as that.
Yeah, I agree. I think the rules are going to change for most people. So people are going to say, oh, the Fed's not allowed to do this. You're a conspiracy theory. And then, those people are going to be proven wrong because the Fed's going to get the rules changed, because we're already seeing Janet Yellen and Larry Summers, and there's a number of other people that are already the new guy is David Rosenberg. I think he's a Keynesian who works for a private bank. And these PhD Keynesian economists are already saying, oh, we need to print $2 trillion more for infrastructure, or we need to, bail out all the college students here in the United States who have student loan debt. We need to buy up all their student loans so they can, be regular people and not be debt serfs. But you've talked in the past about Libor rising rather than central banks allowing interest rates to rise. What do you think that signals?
Well, I think it's quite simple. I mean, there was, over the last, I suppose, 6 months or so, people have been talking about Libor rising because money market funds have been moving out of lending to prime borrowers into lending to the government, because of this breaking the buck thing and all the rest of it. I'm sure that's part of it. But the reality is the reason that Libor is well above the Fed funds rate is because the Fed funds rate doesn't reflect reality. The real cost of borrowing dollars is reflected in Libor, and 3-month Libor is around about 0.8 to 0.9%. That is well above the Fed funds rate. So it is hardly surprising that you see American banks lending money into the money markets and drawing down on their reserves in order to do so. And this is not the start of the rise in Libor. I mean, Libor's been going up for the last 2 years, and that is principally why the level of reserves held at the Fed has fallen, because banks are doing the arbitrage. It's as simple as that.
Now, I want to transition to the gold and silver markets. I want to ask you about Deutsche Bank being fined only $38 million for settling its silver manipulation of the London silver fix. Do you think this was way too low of a fine, or do you think in exchange for them handing over more evidence during the discovery process that the information that we're going to uncover about more gold and silver manipulation, it's worth settling with them for such a low amount then?
Well, what worries me about these fines is that the system basically sees it as a source of money, and I think that is morally wrong. Now, having said that, I think if Deutsche Bank has been legging over the market, legging over customers, conspiring, if you like, to fix prices, then that is equally wrong. And I think the remedy basically should be in the hands of the people who have been wronged. And the only good that has come out of this is that because Deutsche Bank has admitted that it has done wrong, then it can allow a process of discovery for those people who are wrong to actually sue the bank. And I think that is a very, very good thing. But what is important is that if you're looking at a conspiracy, which is effectively what we're talking about, then the question then is which other banks are involved. And I'm going to be fascinated to see what the discovery process actually reveals in that context.
Yeah, that's a great point. And you brought up morally wrong. I mean, there's so many things that are morally wrong. It's morally wrong, in my opinion, for a central bank to go out and start buying corporate bonds, to go bailing out their friends and cronies. It's morally wrong for central banks like Switzerland to start buying up all these stocks, and the Japanese central bank to do that. It's morally wrong to suppress interest rates for retirees who need it, who don't want to work a job, they're not physically able to go out and be forced them to go and take risk to have money to retire on. So there's just so many things that are more, and don't get me started on the politicians and how corrupt they are for morally wrong.
No, I agree with you entirely there. But I mean, if you're going to give someone the ability to print money, then what do you expect?
Yeah, I mean, Alexis de Tocqueville in Democracy in America and Frederick Bastiat over 150 years ago, both of them, I mean, they predicted that this would happen, that, politicians would start to bribe people with their own money and, the level of corruption that would occur. It just took a long time to get to these levels of corruption, I would say.
It's happened throughout history, I can tell you.
Yes, and you actually wrote a very good article about the U.S. empire declining historically, and I think one of the things, I don't remember if you mentioned this exactly in your article, but, when you got to the end of the British Empire, when you got to the end of the Roman Empire, there was always corruption in those empires, same thing with the U.S., but the levels of corruption had just, doubled or tripled from the original when it had started, with regulation and taxes and spoil systems and cronyism and things like that.
Well, to be fair, I think that is generally true, yes. But I think to be fair, the British Empire was not as corrupt as many of the others. I think what happened really was that Harold Macmillan, who was Prime Minister back in the late 50s and early 60s, understood that Britain could no longer afford to run an empire. It could no longer withhold the tide of nationalism, particularly in Africa. And that's what led to his Wind of Change speech in South Africa, which from memory I think was something like 1960, 1959, round about then. And it so happens that my uncle, Ian Macleod, was appointed colonial secretary, and he was given the brief to dismantle the colonies. And give independence to particularly the African countries and also countries like Singapore and so on and so forth. And that he did with, as far as the settlers in those countries were concerned, he did that with indecent haste. But having said that, if you stand back from that period of history and you see that Britain actually disengaged itself from those obligations, that I think was it was a really good recognition by an empire that things had changed and it could no longer maintain its position and therefore accept reality. I just wish that other empires did exactly the same thing. And we're not seeing this, unfortunately, with America, and it seems to be leading us into potentially a very unpleasant conflict in Syria, where a war is being fought by proxy. Really, there's a civil war in Syria. But you've got Russia on one side and you've got America on the other. And I think that is, I think it's appalling.
Yeah, you're exactly right. The U.S. is fighting the end of its empire. We haven't slashed the amount of military bases we have all over the world. In fact, I think we want to open up more. Donald Trump is talking about spending more money on the military. Hillary is basically a neocon candidate. She's backed by the military-industrial complex, and she's talking about during the debates this no-fly zone in Syria. Well, the only way to have a no-fly zone, right, is to shoot down Syrian or Russian planes. So that really scares me about the potential for a World War III. So hopefully that doesn't happen. Hopefully Hillary Clinton doesn't win the election, although I don't think Donald Trump is really that much better. His foreign policy also scares me. But, those are the two main candidates. I'm not voting for either. The remaining part of the interview, though, Alasdair, I want to talk about the gold and silver market. Did you see the story? I think I emailed you this, that the ICE exchange, which set up U.S. stock exchange to stop high-frequency traders, is now teaming up with Sprott Incorporated, which is Eric Sprott's company, to set up a London gold futures contract exchange that will be physical. So all settlement will be in physical gold exchanges, and that's going to launch in February.
Yes, I did see that, and I wish it every success. I have slight reservations about its success. I think firstly it is doing something in line with what should be done, and China again, unfortunately, is leading the way on this with the Shanghai contract. I think, however, that the hedge funds, who are, if you like, the real speculators, other than the banks, of course, but the banks don't really have to put up margin. But the hedge funds, when their idea of speculation, I think, is don't get involved with physical at all. So I think, in a sense, having contracts backed by physical almost guarantees that those futures contracts will not overturn COMEX. I'm afraid that is the case. At some stage, I think COMEX might get into difficulties because I can certainly see a day coming when the price of bullion rises. There's such a scarcity of bullion that the price rises to the point where perhaps even there may have to be a declaration of force majeure on COMEX. But until that happens, I think that COMEX is still going to continue to be the largest center for speculation in gold and silver. It's basically a huge, great casino, and no casino increases its business by imposing strict rules on its punters.
Okay, I get your point. So then, to summarize your point, then for our listeners, you don't think that this new exchange that is being started will attract the volume and take it away from the LBMA and the COMEX that people are hoping for then, and that people hope the Shanghai Gold Exchange would as well?
I don't think I'd put it quite as strongly as that. What I would say is that I think that there is a little bit of an uphill struggle given the freedom for banks to deal on COMEX without actually having to put up anything at all.
Okay, fair enough. Now, we've recently had good research work by Louis Camarsano over at Small Gold, and he's revealed that central banks such as Switzerland and Norway own gold and silver mining shares. Do you think then that we're going to see more central banks instead of actually buying physical bullion, because they know if they bought a lot of physical bullion, a lot of these central banks started buying it, that it would drive up the price very quickly? Do you think then that they're going to start hedging with gold and silver mining shares a number of other central banks?
No, I don't. I think actually what these central banks are doing is they're looking at their reserve position as a sovereign wealth fund. And as soon as you start talking about a sovereign wealth fund, then you're moving the goalposts hugely. It's no longer a reserve situation to use in the defense of your currency. It suddenly becomes an investment portfolio. And that's actually what these countries are doing. It's the amounts of money involved, if you go all the way around the world, are absolutely massive. I can't remember. I have a recollection that the amount of liquidity, immediate liquidity, is something like $9 trillion out of all the sovereign wealth funds. And if you start including the reserve positions of the central banks, that obviously increases again. And this is actually, I think, what you're seeing. I suppose that if you're sitting in Switzerland as a central banker and you see everything falling down around you, then you perhaps, yes, you've got a gold policy, and unfortunately there's not a lot you can do about that because you have discussed it with your confrère, if you like, in the meetings, the 2 monthly meetings at the Bank of International Settlements, and it's been made quite clear by the Americans that they don't want you to upset the gold market. Okay, so we can't do anything there. Perhaps we can go and buy something instead, which sort of more or less tracks it. There could be that element to it. But broadly, I think it is completely wrong for a central bank to use its monetary reserves to speculate in equities or anything which is not currency or near currency. I would even regard the holding of long-dated debt as being speculation. I think that a central bank should limit the maturity on its debt to 5 years, and it should never, ever buy equities at all. That is not its function.
Yeah, and yet we find ourselves in this new normal. And I would add that the central banks are creating digital currency out of thin air. When Switzerland was running a euro peg, they were creating all this extra currency to buy up assets. So these central banks, this is not from, their reserves in a lot of cases are not from actual trade. They're just printing up extra currency units to buy up extra assets, either bonds, government bonds, corporate bonds, or, now stocks. So we're in, twilight zone now. We've just gone to really the extremes of monetary policy. We have politicians now talking about Donald Trump is talking about a $1 trillion infrastructure spending program in the U.S. Hillary Clinton wants over $2 trillion. That's based off Larry Summers' numbers. My last remaining question for you, though, is about the relationship Russia and China have now in the gold market. We know that they're doing these trade deals together. They're building bullet trains and Silk Road type of deals on land and overseas. Why do you think Russia then is agreeing to sell China, small amounts of physical gold each month? And why do you think China then is also importing now physical gold through Beijing in addition to Shanghai and Hong Kong?
Well, firstly, I'm not aware that Russia is actually supplying any gold to China. I mean, it would be quite possible that China has offered cheap processing facilities for Russia, and under those circumstances, they could well buy gold doré, particularly from the sort of Siberian end, because the transportation of it is by rail. It just goes straight into China, gets processed, China pays for it, and that's the end of the story. So it wouldn't surprise me at all that China is acquiring some Russian-sourced gold by those means. But I don't think what I do not see is Russia as a government officially supplying gold to China. China is also processing doré coming out of Mongolia. Now there it's got a monopoly. And also, I would suspect that it's doing the same thing from various countries north of Tibet, all the various stans going all the way around to the Caspian Sea. So there is no doubt in my mind that China is continuing a policy of gold accumulation. I mean, most of the mines that that the state owns or are operated under state license are really not that profitable. But having put the investment in, she now produces something like 450 to 460 tons per annum. This is considerably more than any other country. And where does that go? Well, I can tell you one thing. Chinese state-refined bars are hardly ever seen in foreign markets. They're just not available, if you like, on the international market. And I've had that confirmed talking to our refiners, who see all sorts of stuff coming in for reprocessing. So that tells me that the Chinese are still accumulating their own gold. To that extent, I think the figures that come out of the Shanghai Gold Exchange about deliveries and all the rest of it are slightly suspect. They may well understate the situation. And not only that, but China is the only country, so far as I'm aware, that has actually advertised on TV and in the media telling its people to go and buy gold. And that is quite remarkable. So one way that I think, as far as China is concerned, they do see gold as being the most important element in their future security at a time when it appears more and more likely that the fiat currency world of the West is firstly threatened and secondly likely to eventually collapse. So I think that is the thinking, that is the strategic thinking behind China's accumulation of gold. But I don't think I don't think you're seeing Russia supplying as a government, if you like, China. I can see China taking in doré for processing and buying that doré on assay and retaining the gold.
I think I read it was a few weeks ago, maybe a month ago. It was only for 10 or 15 tons a month, and I'm not sure if it was directly through the Russian government or if it was a private entity, but maybe it was in exchange for oil, like a long-term oil contract, because the oil price is not at a level, and China may have agreed to buy the oil above spot price, because China has done that before in Russia after the 2008 crash, and they've done it with Brazil after the 2008 crash. They agreed to help those other countries out and buy oil on a longer-term contract above the spot price. So there might have been some type of trade in exchange for a small amount of gold supply. I think it's a long-term deal with whatever Russian entity it was signed, but it's only for like 10 tons of gold a month. It's a really tiny amount.
I think it's unlikely, actually. I can see an oil for gold deal, if you like, with the gold being supplied by private entities. That I can see. But I don't think that the Russian government is in the business of supplying gold to anyone. If anything, they are accumulating gold. So that would go completely against central bank policy.
Yeah, and you've said in the past you think China has over 20,000 tons of gold at the government level. Obviously, the private sector is accumulating a massive amount. I think, China's demand did slow down when the paper price was rising. The bull market restarted in December of 2015. We know that the Chinese numbers for physical demand slowed down as the paper price was rising here in the West. But now that we've had a correction, we know the demand numbers are showing that China and India are starting to buy a lot of physical gold again. They have more disciplined buyers over there than here in the West that chase the paper price higher. So they were waiting for a drop in the paper price to start accumulating more physical metal.
I think you have to draw a distinction between gold which is sold for jewelry and gold which is sold in bar form. I have no doubt that the jewelry market is more price sensitive than the investment market. We see this from our own experience, I think, in the West anyway. But certainly in China and also India, you have seen, if you like, a slowing down of demand for buying jewelry. Now, I'm not saying that people who buy jewelry don't regard the gold in their jewelry as an investment. I mean, certainly in India, the markup in terms of processing is something like only 10%. So, it is virtually bullion, if you like. It's just not it's not just acceptable, accepted in that form into a vault, but nonetheless it is bullion. But I think we do need to have this slight distinction in behavior between the acquisition of jewelry compared with the acquisition of gold in ingot form for investment purposes. And I think it's the jewelry side which has really slowed down. The last figures I had out of China actually indicated quite a big pickup in deliveries from the Shanghai Gold Exchange. So, it could well be that from that point of view, the lull is behind us.
Yeah, and I think, the gold and silver bull market is still back on. People ask me to give them a price target on when the gold and silver bull market is going to end, and I tell them, well, tell me when the central banks are going to stop doing really crazy things with interest rates and devaluing currencies and things like that. So I'm not going to put a price target on when gold and silver, the bull market's going to end, because tell me when the central banks are going to stop doing crazier and crazier monetary and fiscal policy combined with the politicians.
I think that's very wise, Jason.
Well, you guys are doing great work at Gold Money now. You've combined with BitGold. The stuff you are offering, you are actually able to navigate the red tape, the regulations, and get peer-to-peer gold. That was just announced, I think, yesterday. You're able to get Americans to send peer-to-peer gold from one American to another. No one thought you guys would be able to do that, and yet you have. So congratulations on that. You're over 1 million customers in barely over a year. Not many businesses can say they ever have 1 million customers, and you guys have done it in only about a year or so. So it's pretty fantastic, the potential that your company has.
Well, thank you very much. I'm very excited about it, I must say, because my, if you like, mission, passion, however you like to describe it, is to bring the benefits of sound money to the ordinary person. And the reason I I backed BitGold's acquisition of gold money right from the start was because I could see that that was precisely what the management of BitGold were trying to do. It was very much in line with my thinking. And the thing that's important is they have got the energy and the expertise to do it. I haven't. So I'm very glad they're doing it. And I'm very, very happy to be part of it.
Yeah, I'm excited to see where the company goes. I think it has an enormous amount of potential. And as governments and central banks, continue to come up with new ways for cashless society, the war on cash, negative interest rates, there's been talk of even having charging depositors here in the U.S. for their checking account and savings account. I think one or two German banks are already doing this. If that happens, the alternative of taking money out of the conventional financial system and taking money out of a regular bank account and putting it into something like gold money, it's going to increase the incentives to do so more and more.
Well, I couldn't agree more.
Well, Alasdair, if our listeners want to read your great articles, how do they do so?
They're published on Gold Money's site. If you go into the wealth section, you'll find that all the research is under there. I also publish my articles on financeandeconomics.org. So those two sources. Also, I think as often as not, Zero Hedge publish them, but probably about 2 or 3 days after they've been released on the website.
Excellent. Well, thank you for your time, and hopefully you'll come back on again in the near future, and we'll talk about the gold and silver market and other central bank stupidity.
I look forward to it. Thank you very much, Jason.